GDP is probably the single most important number in fundamental Forex analysis. And if you have ever watched a currency pair move 50 pips in seconds after a data release, there is a good chance GDP was behind it. Gross domestic product measures the total value of goods and services a country produces over a set period, usually reported quarterly. Think of it as the broadest possible health check on an economy. It captures consumer spending, business investment, government spending, and net exports, all rolled into one headline number. The figure traders care most about is the growth rate, how much GDP changed compared to the previous period, and specifically, how that number compares to what analysts were expecting. That gap between forecast and actual is where the market reaction lives. Beat the forecast, the currency usually strengthens. Miss it, the currency often falls. Simple in theory, harder to trade in practice. There is also a distinction worth knowing. Nominal GDP is measured at current prices. Real GDP is adjusted for inflation. Forex traders focus on real GDP because it shows genuine economic growth, not just price increases inflating the number. In the United States, GDP comes out in 3 stages: an advance estimate, a second estimate, and a final reading. The advance estimate, released roughly 4 weeks after the quarter ends, gets the biggest reaction because it is the first data traders see. Later revisions can still move markets if they land far from expectations. The Bureau of Economic Analysis publishes U.S. figures, the Office for National Statistics covers the UK, and Eurostat handles the Eurozone. An economic calendar tells you exactly when each release is due. Now, why does GDP move currencies so directly? Strong growth attracts foreign investment. Investors buying assets in a country first need to buy that country's currency, which drives demand and pushes the exchange rate higher. There is also an indirect channel through central banks. Strong GDP can raise inflation concerns, which can push central banks toward higher interest rates. Higher rates make a currency more attractive to yield-seeking investors, adding further upward pressure. The chain works in reverse too: weak GDP, rate cut expectations, lower currency. Trading around GDP releases carries real risk. Positioning before the number drops exposes you to violent, unpredictable moves. A more disciplined approach is to wait for the initial spike to settle, then look for a clear directional trend to form, confirmed by technical signals. Also, context matters. If a currency has already rallied hard on positive data in the weeks before a GDP release, even a strong number can trigger a sell-off as traders take profit. GDP never moves markets alone. Combine it with employment data, inflation figures, and technical levels to build a complete picture before you act. That combination of fundamentals and technicals is where informed trading decisions come from. And trading always involves risk, so only commit capital you can genuinely afford to lose.